welcome to TradersPost office hours for February 2nd, 2024. It's gonna be fun. It's gonna be fun to go through these things, go through some community questions to answer things that people need to know, either preemptively or things that people have posted in comments or on Discord or have asked us directly. Because we always want people to learn more about our platform, get better at using TradersPost, and create more profitable and more complex or simple strategies. So thank you, Mike, for joining me today.
You bet, Tom. I'm super excited about this. Covering questions every week, I think, is a new format for us, but I'm really excited to hear what people have to ask about Traders Post or even just algorithmic trading in general. Give us the challenging questions, give us the simple questions. We'll cover all of it.
Excellent. So, to start off with, I thought it might be fun to, as a general question, because it's something I wonder myself, is how do people even come up with strategies? How do they actually find these strategies? Like, other than being a coder or being a professional trader yourself, if you're just getting into the whole business, how would you even go about finding a strategy that might be profitable?
Sure. Okay, let's unpack that one. That's a great question. Obviously, I think there's probably some high level things to cover. In general, it's fair to point out that many strategies have been developed as far back as the 1980s from an algorithmic perspective, and there are still papers that have been published on several different approaches to markets and several different ways in which technical indicators have been tested at large as part of the CMT program. Some of what I've learned is about how those studies have attempted to sort of refute the legitimacy or the usefulness of technical analysis, if you will. But there's such generic approaches to using those indicators that it doesn't quite delve into how indicators can be used to measure the things that really do work, which ultimately are around support and resistance, overbought and oversold territories, indicating for reversals or for continuation. We know that in general, most strategies out there fall into either the momentum or trend following category or mean reversion. And in general, systems can be made in either of those two categories. While there's a lot of research out there that shows how many indicators can be built and how many strategies can be built by leveraging different sources of data, different time frames, maybe even just thinking about the market in a different way. I think that the way that you come up with a strategy is really by starting from the ones that already exist. Pull something off the shelf, try to understand the merit and thesis behind it, and then maybe start to use that as inspiration for something that you can do on your own. Um, I have sort of an artistic background. I started on guitar when I was 11, and I think the way that I learned guitar was to play every song that I loved. My first introduction to guitar was just learning how to play "Smells Like Teen Spirit" by Nirvana, and once I nailed that and had the lead progression down, then I felt like I kind of got the structure of grunge rock songs in the 90s. I think it's similar here where we get an opportunity to pull something off the shelf, examine its merits, and then maybe take some inspiration from that and combine some ideas from other resources. So coming up with a strategy itself, I don't think is terribly complex. Coming up with a strategy that actually has an edge, that has the ability to win more than it loses, and makes more when it wins than the losses you take when it loses is tough. That positive expectancy is a tough thing to achieve, and in general, like the vast majority of like trend following strategies have um, they have a positive expectancy of around 1.5, right? Like that zone seems to be pretty typical. So the aim, of course, is to find the holy grail. I don't know that that's really achievable. I think a lot of retail traders are under the suspicion that if they just pull a couple strategies off the shelf and they change enough of the numbers, that they are likely going to find the holy grail strategy. And of course, that's not quite what's happening here. What tends to happen is uh, the trap you may find yourself in is grabbing a strategy and running through every number in the settings that is possible until you find something that gets the numbers that you're looking for. But what you've most likely done at that point is just curve fit that strategy, which is the same as going through the chart historically and finding every point that had a perfect down point and every point that was a reversal at the top, and saying, see, if I bought here and I sold here and I did it these last 17 times, I would have had 100% success rate. And that's not quite how markets work. They're going to change in the future. So you want a strategy that will hold up to the market conditions that you're looking to create a signal for, over and over and over again. So it's tough. I think to develop a strategy takes not just the inspiration of how great strategies work or how the merits of the thesis works, but it takes a lot of research to understand what's happening in the background, who the buyers and sellers are, where the order flow is coming from, what causes reversals in the first place, where the sentiment of the market is. There's a lot that I think is worth understanding about markets before you head down that path of developing a strategy.
It's so interesting because the two refrains I hear regularly from clients who come to me to develop strategies is, one, they say, well, there must be holy grail strategies out there, and the reason you don't hear about them is that no one gives up their holy grail strategy, so I just need to find my own, and then I'll be one of those secret people making $1 billion a year. Or they
Sure.
think to themselves, well, this YouTube video that has 100,000 views says it can make $3,000, 3,000% profit if it just runs these three indicators. And so, Tom, make this thing for me. It'll make this amount of money. And then, hey, I'll be rich. I hear it all the time. I'm always so surprised. But there is it's something I've been enjoying, get it drilled into my head through our conversations since we've met, which is this idea that the a strategy can work for a certain period of time and then not, and just stop because it's conditions within the market don't support it anymore. So that idea that a strategy could work sometimes and not other times, I'm really finding it challenging to sort of like get on board with, like to really understand, to internalize, because I think to myself, well, if I'm following a trend, following strategy, and it's supposed to be taken buys and sells, well then it shouldn't matter what market I'm in. But then you deal with slippages, you deal with black swan events, you deal with all kinds of different things that can be miscalibrated, and all of a sudden your strategy doesn't work anymore. The other thing is this idea that uh, well, you can follow fundamentals, you can follow momentum, you can follow technical analysis, and they all have their pros and cons to it. But I'm curious what you think about, do you need a mix of these different things? Do you need a mix of components for a strategy to work, or can you just literally rely strictly on fundamentals, rely strictly on technical analysis?
That's another loaded question. So I think you can 100% be a devoted fundamental investor, meaning your aim is to hold long term and invest in well valued companies that have great fundamentals, have great price to earnings ratio, or have great profitability over the long run, have great market share, and so on and so forth. And your aim is just to find these companies to add to your portfolio that continue to have good fundamentals until maybe ultimately they're overvalued and you've decided that they're no longer worth keeping in your portfolio because their value is so high that they now take up too much weight in your overall mix. So you kick them loose so that you can buy something else that might be undervalued. That might be one approach to the markets. There are, I think, fundamental filters that can be used in addition to technical analysis. Like you might say, I have a signal I'm using that's on a longer daily or weekly time frame. It uses technical analysis. I'm using a long-term, weekly moving average, maybe a 200-week moving average, for example, along with maybe some measurement of the VIX. And I want to also include only companies that have a lower price to earnings ratio because they might be potentially undervalued while we're in a downturn or in a drawdown in the market of some kind. So we're in a valley of some kind of measured that we're well below the 200-day moving average. We're in this zone where it's a good opportunity to buy undervalued companies because the market is pretty fearful. And as we all know, the adage, it's better to be greedy when others are fearful and fearful when others are greedy. Then maybe that's a good buying opportunity. And I think something like that can combine fundamental with technical analysis. And then you've got people who are entirely on the other end of the spectrum and have no interest in fundamentals whatsoever. They only want to trade price action and are only interested in the way the market is expressing its viewpoint on price on the candles.
Excellent. Well, that's good to mull over. What I'm going to, all right, I've asked you too many personal questions here, Mike. Let me get to what people have been asking us. As far as choosing a broker is concerned, there's so many different brokers out there, and there's a subset that are available on the TradersPost platform. What are some of the criteria that, let's say, you were to choose personally? Some of the criteria that you look for to to decide which broker to go with.
Sure. Um, I love the brokers that support all of the methodologies for automated trading. And so, one of the things we iterate over and over again in a lot of customer support tickets and in a lot of suggestions on strategy development is to keep your orders with the broker so that you get guaranteed execution. And our meaning behind that is if you have a take profit or a stop loss that's attached to your entry, and maybe there are levels in TradingView or there are alerts in TradingView that you've established, and your expectation is that when those trigger, it's going to trigger a webhook to TradersPost, which will then translate to an order at the broker. Well, you've created a little bit of a delay there, where when the price alert triggers from TradingView, it heads over to TradersPost. That takes about a second. Then we go from TradersPost to the broker, and then we issue an order. That's another 500 milliseconds to a second. And by the time it actually gets to the broker and executes, 2 seconds have already gone by. Depending on what's happening with market conditions, a Fed decision day, or maybe price action is just really choppy at the moment, that could lead to some slippage, especially if it's a market order. So our suggestion is use the brokers that allow you to attach your take profit and stop loss in advance with your entry. And we have a broker list on TradersPost where you can run through all the different features that they support. TradeStation happens to be one of those brokers that just has a green checkbox on every single feature that we love to see. But having the ability to attach that take profit and stop losses is one of the things that they do support. I think Alpaca does as well, but TradeStation is definitely one of our preferred and suggested brokers. The idea there is now when I take my entry at $100, maybe I have a 5% take profit and a 2.5% stop loss. Well, I send those orders along with my initial entry from TradingView. So now when the entry triggers, I'm in the position, but I've already told the broker what my take profit and stop loss is. Those orders are now already set. I have a stop limit order and a limit take profit order, and those get executed the moment that price triggers at the broker level.
Yeah, this is something important to remember because you can develop the strategy in full where it's deciding on what kind of orders you're taking, what are the price levels are at. You can do that all within PineScript or whatever coding platform that you're using in order to generate the signals. You can have that all taken care of there, or you can have part of it, that burden held by TradersPost, so that the orders, like Mike was just saying, are executed faster. At the broker. You also get the advantage of not necessarily having to code all those different types of circumstances, all the logic that handles that within the coding platform itself. So it is good to know if you're dealing with a broker that does have like TradeStation, that does have all these different types of order execution types, and a platform like TradersPost that can integrate with that, you can save yourself a lot of hassle. Does TradeStation allow for options trading? I can't remember that off the top of my head.
They do, but we are still sort of refining the options integration there with TradeStation. The the I think there's just a couple features left, but it is currently supported on TradersPost. I think we have a couple of things we're adding to it, but yeah, it is supported at the moment.
Cool. I was just wondering, I was curious about for options trading, if you see any type of mistakes or hurdles that people have to watch out for when they're developing or when they're implementing a options trading strategy using TradersPost. Is there anything like words of caution or any advice you can give to people who want to implement that?
Yeah, one of the things I think we see come up quite a bit on the option side is the amount of slippage that can take place with each of the contracts. And sometimes the price can move so much that if you have a filter on your options contracts at Traders Post, where you're only willing to take a contract that's two strikes away, for example, that might be such a tight filter that it causes us to not be able to execute your order. So we tend to say you should keep at least 4 to 8 strikes away in order for us to find a position that makes sense. Um, but I think that's one of the more common things that occurs.
Okay, excellent. Um, I'm curious, do you see, well, this is a little bit inside baseball sort of thing, but I'm just wondering if people with options, automated option strategies, end up generating higher profits than people who trade just the futures or the or even just the stocks because of the convexity of the trade. Does that come into play? Do you see that at all?
Uh, I don't. Can you hear me? Okay.
Yeah.
I don't necessarily see that in Traders Post. I don't have that data to provide, but I think what you're describing sounds a lot like tail risk strategies, where with the right approach, you can sort of snipe out deep out of the money puts that have stronger convexity to their payoff relative to a buy and hold approach. And I think there is an opportunity to automate something like that, where over the long run you can wait for good market conditions where the VIX is low and the premiums are low and buy deep out of the money puts in order to protect the long exposure that you might have.
It's something that's really exciting me. Like today, Meta went up 20%, right? And you're thinking to yourself, okay, and on earnings, and we just released this market earnings tracker on the Traders Post blog that allows people to sort of monitor what type of large cap stocks are headed into earnings. Um, and I think to myself, oh well, if I develop an automated options trading strategy that can revolve around that can place those take those high convexity deep out of the money trades, maybe that might be something that might be particularly profitable, just to set something like that running on the side. Might be interested in trying it out.
Yeah, for sure. I think that's hard to test. I think there's a couple platforms out there that I would recommend testing that on. Quantopian, I think, is a good platform for testing options trades in that way, where you can test different scenarios like the ones you're describing. But test it on both sides of the market when we have melt up and meltdown scenarios, because it's the value of those premium changes pretty significantly on the put side if you have melt up scenarios like Facebook just did. So it would be interesting to test for sure.
So is this something when it comes to the to paper trading on Traders Post, uh, does that account for options? Like, could I paper trade options with one of these brokers?
Yeah, so you can paper trade options with TradeStation, and you could certainly send signals from Traders Post in order to simulate what those orders might look like, and get a sense of whether an option strategy would work. Um, it's tougher to, there's not really a way to back test that per se. It's more of a walk forward approach, where maybe you've established a strategy, you have the signals you're looking for, and now I want to just start sending signals to Traders Post, but simulate them through a paper account. That's certainly something you could do through TradeStation.
Awesome. Well, that's my weekend setting that up. That's what I'm gonna do.
Let me know how that
I'll just
goes.
leave off here with a general question. Right, of course. Well, if I hit the holy grail, I'm not telling anybody, Mike. Obviously, I'm keeping that close to my vest. Or I'm developing a YouTube channel so I can get 1.5 million views some commissions on that.
Just say you
I
have a
think
100% success rate and 3,000% returns.
that's the formula. That's the SEO term to optimize for. For the so we've talked about before in different videos this idea that, I mean, you've talked, I've listened and tried to listen very carefully, that the game is about risk management. You know, how much money do you not want to you don't want to lose money so that you can gain money when those opportunities to gain money are is there. You can't go long if you have no money. So as far as stop loss are concerned, are there any types of measures that someone can take to safeguard against situations where a stop loss order doesn't get executed as per my signal? Like, does TradersPost offer any type of backup options for such a scenario? So let's say my script, my strategy that I'm running on TradingView and PineScript, I'm relying on myself in order to do the stop loss. But what if that stop loss signal doesn't come through? Is there something else that can be done on the TradersPost side in order to mitigate any type of losses?
We do have retry events if the order fails for any reason, but that's a very rare event, and it's only under the circumstance that we have an issue with the broker. So if we make a connection and their API call fails, then we do retry that, and that is in your strategy settings. However, I think the scenario you might be describing would be a slippage event where you might have a limit stop order, the price triggers, the limit order is set, but the price has slipped so far down that your limit order wasn't executed and no part of your order filled. And now the price is falling even further here. You can cross your fingers that the price comes back up and actually executes at the limit order that you set. That's one approach. The other approach is also broker contingent. Some brokers allow you to set a max drawdown for the day. You could set that setting in place at the broker level so that if there's an account level drawdown that exceeds a certain percentage, then they automatically liquidate your positions. I know like Trade provides that, which is a current integration we're almost complete with. And I think TradeStation has that as well. I'd have to dig deeper. But um, you can also do this at the trading view level in your strategy. There's also max drawdown calculations that I've seen built into strategies where if the perceived drawdown is greater than some percentage, then you could send out an alert that exits your position so that you're not exposed to any more particular loss. That's a tougher one to get right because the trading view environment doesn't have perfect context of your orders. So it might assume that your limit order was filled when it actually wasn't. And so it doesn't actually monitor the drawdown appropriately. Um, but beyond those two measures, it can be difficult. So the the I'm hesitant to provide any kind of opinion about using market orders because obviously market orders you're guaranteed an execution, but that might cause so much slippage that it was worse than the perceived slippage that came from a stop limit order. So it's a tough one, but the to your exact question, there's nothing at Traders Post at the moment that perfectly protects against that scenario.
It still sounds though like sometimes it might be wise. Occasionally, it might be wise to set up the stop loss parameters on Traders Post as opposed to strictly relying on it in your strategy, because at least at that point, you it sounds like you have less points of failure because on Traders Post it's there, the retry option is there, and you're closer to the broker for execution. So it might not be valuable for everybody all the time, but to have that option there, it certainly seems like something to keep in mind.
Yeah, I think that's a good point. So, like when it comes to a stop loss on Traders Post, you have three ways you could do it. You can set up an alert in TradingView that's based on your strategy, which then sends a signal to Traders Post, which then executes a stop order at the broker. You can create stop loss settings within Traders Post, which takes away one step there and one potential gap of time, so that when we see the price change at Traders Post and it triggers the event, then we'll send the stop loss order to the broker, and should see it execute from there. Um, if and that applies to the scenario where your strategy sends an entry and we send an additional stop limit order with that broker. Now, of course, the best approach and the one that we recommended earlier at the start of this is to send your limit orders to the broker in advance so that it's executed at the broker level, and you're more likely to see an execution there. The scenario I just talked about was a rare but totally conceivable scenario where it doesn't really matter which of those three steps you did. You can still see slippage on a limit order. That's just the nature of pricing.
Right. Okay. All right. Well, that's great. Always love talking to you, Mike. A wealth of information. I always like to talk to people who know more than me, which doesn't happen often. I'm a genius, as anybody knows. So just to let everyone know that we will be doing these office hours every Friday. So if you have any questions, you can feel free to leave them in the comments of this video, or let us know on our Discord server or on Twitter, and we will be sure to pick them up and answer anything that you might have. Our goal, as stated before, is to make sure that TradersPost becomes the best automated trading platform for you and your strategies, and we need you for that. We need you to let us know what would make things better, what your pain points are, the things that you like, so that we can address them either here or in the back end as we develop the platform every day for you. Is there anything else, Mike, you'd like to say before we leave it off?
I don't think so. I think you covered it, Tom. Appreciate it.
Excellent. Perfect. So that's it for us, and we'll see you next Friday. Bye, folks.
Awesome. Take care.